To discuss the Witan Investment Trust's half-year results to the end of June 2020, I'm joined now by its Chief Executive, Andrew Bell. Andrew, it was an incredibly volatile first half to the year, particularly between February and April. How has the Trust performed?
Poorly. We experienced a total return loss of 14.7% over the 6-month period, which was a long way behind our benchmark, which had a loss of 2%, and our discount widened from just under 1% to almost 6%. Now, although the circumstances were very exceptional, this is totally atypical for Witan, and it's something we deeply regret and are determined to reverse.
So what were the reasons for this underperformance?
We were caught out by the unexpected plunge from expectations of moderate economic growth for 2020 to the reality of a deep recession, and as a result we owned the wrong kind of stocks. We were invested in, on valuation grounds, in economically sensitive stocks and non-US markets, both of which performed absolutely terribly in February and March. Since May, our performance trend in relative and absolute terms has been better, but the market has not really noticed that yet, and we've taken advantage of the resulting wide discount by buying back a lot of our shares on wide discounts, because it's accretive to the NAV for remaining shareholders, and eventually it will contribute to narrowing the discount.
Well, you mentioned that we're in a very changed economic environment, so how have you responded to that? How are you responding to that for the longer term?
We've reduced our exposure to the UK and Europe and systematic value strategies. That's partly because of our change in benchmark to a more global outlook at the beginning of the year. We've continued to reorientate our portfolio to be in line with our new benchmark, and with an accent on looking for exposure to faster growing areas of the world economy.
In January you changed the benchmark from 30% UK, 70% global equities to 15% UK and 85% global. Can you give me some more detail on the underlying changes you're making to the managers as a result of that?
Principal driver for the decision a year ago to change our benchmark, which took effect from January this year, was to give ourselves greater exposure to faster growing economies and sectors worldwide. So in future we're going to have approximately 2/3 of the portfolio managed by global equity managers who are able to select the best stocks unconstrained by regional limitations. A further 10% or so will be managed by UK specialist managers, which reflects the opportunities which Brexit and other worries have created in the UK equity market. And of the remaining 20 to 25% or so, approximately 10, as at present, can be invested in special situations in the investment trust sector, such as listed private equity and other specialisms. And that gives us 10 to 15%, which we can allocate to longer term attractive growth themes where you need to choose managers with perhaps a bit more specialist knowledge, such as technology or biotechnology or climate change.
You've announced the appointment of 2 new global managers, WCM Investment Management and Jennison Associates. What was the process for appointing them? What's their investment style?
They're examples of our wish to increase our exposure to companies which are able to deliver faster economic growth and take advantage of emerging economic trends, some of which may have been accelerated by the COVID pandemic and its aftermath with increased working from home and so forth. What they specialize in is choosing companies with relatively little exposure to the economic cycle with longer term growth characteristics, as well as some of the technology stocks which are specifically exposed to emerging economic trends. Now, of course, there's a price to pay for that, because the ratings of some of these stocks are quite high. They've performed extremely well this year, so we're being quite selective in the pace at which we increase that growth exposure, and also in the stocks and managers that we choose.
Well, if you've added 2 new managers, have you dropped anyone from the roster?
We've made a number of changes in the first half of the year. We dropped our 2 European specialist managers as part of a reduced need to be exposed to Europe. We closed the Pzena systematic value portfolio as we felt that the outlook for systematic value was poorer in the new world. And latterly, we've also closed the Heronbridge UK mandate. It was relatively small, 3% of assets, and we've used that as part of the funding for these two global managers.
And the managers you've got running the portfolio, how have they been responding to this underlying COVID-19 crisis?
Well, our manager's objective is to choose companies which can grow their earnings in the medium term, and on the back of that, and buying at the right price, to deliver superior share price performance. So although the economic climate has changed, the objective remains the same. We have made quite a number of changes to our portfolio, our manager list during the first half of the year, and that reflects both our shift towards a more global asset allocation and economic changes which have been in some cases accelerated by the pandemic, and longer term themes such as climate change.
The Trust has got a track record of over 40 years of increasing its dividend. Are you confident you can continue to do that, given so many companies out there have been cutting dividends?
Yes, our earnings, our revenue earnings have been impacted both by cuts in portfolio dividends and also by our shift towards a lower yielding benchmark. However, we've increased the dividend every year for the last 45 years, and we have stated that we are willing to use our revenue reserve, if necessary, to extend that track record of growing dividends to reflect the benefit for our shareholders of a consistently rising income. Over time, we expect dividend cover to rebuild on the back of some of the cancelled dividends being restored and due to the underlying earnings growth of our portfolio. It's also notable that quite a number of leading investment trusts already make use of capital reserves to fund part of their dividend, and we would not rule that out as part of a defined road towards towards a return to normal dividend cover.
The future's certainly uncertain, but what are your thoughts on the outlooks for financial markets?
I think we're strategically positive and tactically very watchful for all the obvious reasons. Fiscal and monetary policy are clearly directed both at mitigating the impact of the measures taken to control the disease and thereafter stimulating economic growth. And I think although we've already had unprecedented measures, I think there are going to be further measures on the fiscal and monetary front. That policy stimulus has already engendered a fairly sharp recovery in equity markets from their March lows, but it's been very lopsided in its impact on different sectors. The growth sectors and those that are non-cyclical have performed extremely strongly, whereas anything that's been badly hit by the recession is still absolutely down in the doldrums near the lows. And we think that once confidence in the recovery picks up, the overlooked parts of the market will catch up some ground, but in the medium term we think it's important to have exposure to both parts, and our aspiration, having restructured our portfolio quite substantially during the first half of the year to reflect a new benchmark and a different world, is that we think that that's going to deliver, is already starting to deliver, but will continue to deliver much better portfolio performance for our investors. And on the back of that, we would expect our discount to narrow further as well. So both of those factors should reward our investors for their patience in sticking with us. That's our aspiration. We can't obviously promise it, but that's what we are aiming to do.
Andrew Bell, thank you.
Thank you.